Okay, recording.
The risk of loss in trading commodities can be substantial and is not for everyone. Only trade with risk capital. Gentlemen and ladies, welcome. Alright, today we're looking at silver, the continuous daily chart. This goes back until November of 2005. Alright, down here we got a chart, and down here we got the commercials. Commercial hedgers are in blue. The speculators are in red. Ignore those, small speculators. And then the large traders, the hedge fund and brokerages are in green. So the green guys are usually wrong when they're super short or super long, and especially if they're the exact opposite of these guys, the blue guys, commercial hedgers. So you've got the commercial hedgers here spike upwards, and bang, price exploded. Okay. Here, let's go here. Here they were their largest, the least short in September, late August, September of 2007, and the large traders actually were the most short. That usually means we're going to see an explosion upwards, and bang, we were right. Went up from 12 bucks an ounce to 21 bucks an ounce. And then here we see in July they round out down here, and we've got a big canyon here, which means they're more short. These large hedge funds and brokerages getting historically long, that usually means a bearish trend, and bang, price dropped. I mean, you saw some rallies, but the price pretty much went down from 19 bucks down to 9 bucks. Now we're up to 10.50. Where's the price going now? That's the question. Well, to get in, you want to look at the commercials, technicals, and the fundamentals to place your bets. But where to go when to get out? Here, this is a 10-year chart. Here we've got, again, this big pinch downwards, and bang, the price exploded downwards. So, how do we know when to exit? Well, let me let you know this. Where to exit with regards to, well, this is where does the price go now? That's the big question. This is a candlestick chart, okay? Commercial hedgers started to get long 17th, 18th, 19th, and the price, started to move up a little bit. It was up here, but then here around November the 3rd started to go short. They started to go short. They weren't as, they were a little bit more short. They dipped a little bit lower. So then the price started to rally. Let's see. The price started to rally, and then but here the price is starting. So potentially the price might fall because they're not less short. They're usually right. So if there's a big jump upwards and they get bullish, or they're just a spike upwards and they're more bullish, or they're less bearish, then we may see a spike upwards. But no, we saw a little bit of a dip. So maybe the price is going to fall. Plus, look at here. This is the Bollinger Bands. Top of the Bollinger Bands. Historically, last couple of months, price hasn't even hit it. Not even close. It's been hugging the bottom, hugging the bottom, hugging the bottom. Bearish chart. You've got lower highs and lower lows. Very bearish. Plus, we're nearing the top of this Bollinger Band. Also, guys and gals, think about what's happening now. The dollar's continuing to rally in the face of a lot of things. Deflation is continuing to be the story fundamentally in the face of a lot of things. OPEC cut the oil supply. Prices still fell. I mean, the Venezuelan OPEC minister, wants to cut another 1 million barrels a day. And will it react? We shall see. If it starts reacting, if we start seeing inflation in the oil markets, the price starts to jack up. If the dollar starts to fall, if the commercials start to get more long or less short, the metals, then we could see a rally in this market. But right now, you want to look at the fundamentals, and the fundamentals look bearish. The technicals also look bearish. This candlestick chart here, this green thing here, spinning top, doesn't know where it's headed. But if you look at here, you got prices going up bang, 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 5. These are 5. Those are all shooting stars, where it's just a line up, and then as the price is heading up, you've got this little block right here, this little thin block. That's very bearish. As if the price is climbing and you've got a bunch of these, generally means it's very bearish. So you've got a lot of things contributing to the bearish tilt of this market right now. If someone put a gun to my head and said, what would you do here? I'd bet this market to fall. I'd bet it to fall another $1 or $2 per ounce, and then consolidate here perhaps for the next month or so, and then wait to see, every Friday the commitment of traders reports comes out. Look at if these commercial hedgers start to get long. Look at if the dollar starts to fall. Look at if oil starts to rally. Look at if the entire commodities complex starts to rally. You start to see inflation. Look at all of that, and all that's important because it may spell the end of this bear market run, and we may start to see prices explode upwards. If anyone put a gun to my head and say, where would you get long? I would think about all those factors, but a really good point, guys, is $14 an ounce. If we got to close above 12, yeah, that's decent. That's solid. If we closed above 14, game on. If we closed above $14 an ounce, and we saw, the dollar starting to fall, commercial hedgers, they get more long. These are key factors that I think would spell a rally in this market. But as of now, I think the price is going to fall here in the next couple of weeks. And nice talking to you guys. We'll talk to you later.